economy in 2015, our guest today is Willem Buiter, Chief Economist, Citigroup, a man with an enviable record in academics, policy making and financial markets. An alumnus of Cambridge and then Yale, Buiter has taught economics at the Woodrow Wilson School in Princeton University, at the London School of Economics and later on at Yale and Cambridge. He was external member of the Monetary Policy Committee of the Bank of England from 1997 to 2000. He was chief economist at the European Bank for Reconstruction and Development and international advisor at Goldman Sachs International. Buiter was also noted for some of his very strong comments about former Fed Chairman Alan Greenspan regarding his handling of the collapse of the hedge fund, long-term capital management, as also Greenspan's overall light touch regulation.
Professor Buiter, we are indeed honored that you're joining us on the world economy in 2015. Let me first start with your view of the global economic growth. Since in the last 2 weeks there has been a growth scare, are you at least reasonably sure that the world economy will grow faster in 2015 than it did in 2014?
Well, our official forecast at Citi is for growth to be slightly faster in 2015 at a global level than in 2014. It's just 0.2 or 0.3% faster, and both the figures for 2014 and for 2015 have been revised downwards from what we were predicting earlier in the year. So it is an incremental improvement next year over the disappointing growth we got this year. So it will not feel like much of an improvement, even if our point forecast is close to being correct. And the risks, I would say, are mainly on the downside.
So you think growth might be slower in the first half of 2015 and pick up in the second half?
Well, it's not just the first half that is at risk. Clearly, the disruption caused by lower oil prices has surprised markets, and this may have some worldwide adverse effects. The fear and anticipation of the Fed implementing its third rate increase is also very much on the market's mind. But on balance, first of all, I believe that the decline in oil prices is actually net a global positive for growth, and certainly for India, which is a net oil importer, and for other net oil importers. It also provides a positive supply shock, and I don't anticipate that the Fed will raise rates in Q1. So I really don't see that there is material risk of a slowdown in Q1 that is any greater than the risk in the second half.
Okay. Well, Professor Buiter, now let me come to the United States. What's your call on the US growth itself? Does it get more robust next year? We've been getting fairly decent data for the second half of 2014. And therefore, what's your call on the US Fed rate hike, both the timing and the pace?
Well, I think it's still more likely than not that the Fed will not increase rates for the first time until later in the year, well into the second half. What they effectively said yesterday was not before April, but that simply lops off the early tail. It doesn't say they're going to raise in April. This is definitely not before. So I think that the Fed will wait till it sees the white in the eyes of inflation, till there are material signs of upward pressure on earnings growth in the labor market. And these signs aren't there yet. Definitely, I think Janet Yellen will err on the side of risking an overshooting of the inflation target than risking an undershooting of full employment. So they're likely to be behind the curve as regards inflation when they finally raise towards the end of next year, and then they'll raise rather faster because they are behind the curve. So I still believe later and faster.
So Professor Buiter, let me come to the other big economy that will determine global growth one way or the other, China. A Chinese PBOC advisor just recently guided that 2015 growth may be at 7.1%. That is slower than the 7.3%, the last number in the current year. Do you see the Chinese growth slowing so much or a lot slower?
We forecast China for next year at 6.9%, and that is for the official figures. And I think the official figures are definitely overstating actual growth at the moment. It is quite likely that if you had a less biased, less distorted estimate of where growth currently is in China, it would barely be at 6%. Right? So I think that the risks in China for growth in 2015 and afterwards are mainly on the downside. China's growth is being sustained by a credit bubble that is now being deliberately fed and encouraged in a way by the monetary authorities cutting rates, making available additional liquidity through the development bank, and a variety of other matters. Earlier attempts to control the housing boom through macroprudential measures and to keep credit tighter have been abandoned for fear of causing an early recession. But I think further slowdowns will occur, and in the end, maybe not this year, not in 2015, but certainly no later than 2016, the most likely outcome is a significant slowdown to 4% or thereabouts on the official data. I don't see that in 2015, but I think that by the end of 2015 the authorities will be more willing to risk a true credit crunch because they know that the current growth model is unsustainable.
Now that's quite a bearish outlook you have on China. Can we therefore conclude that you expect commodities to remain bearish in 2015? Actually, your views both on oil and non-oil commodities.
Yes, well, I think all commodities, with the possible exception of some foodstuffs, will be weak because global growth is weak, right? And global growth is more likely to disappoint on the downside than to surprise positively on the upside. Now, as regards oil, we have the further impact of a supply shock, right? The rapid expansion, at least so far this year, of U.S. shale oil production, cutting U.S. imports massively, and the de facto breakdown of OPEC as an effective cartel. Right? So for oil prices too, I see prices going down and testing some really low levels before finally rump OPEC, basically the Gulf states, will take some volume off the markets and will restore prices to something probably nearer to 70 than to 60 towards the end of the year. But no, it's going to be a good year for oil importers and a pretty bad year for oil exporters.
Okay, let me get done first with an issue that's imploding at this point in time, the Russian problem. Do you expect it will have a domino effect on global emerging markets or financial markets, say because of defaults by banks? Or do you think this is going to be a largely domestic Russian problem?
The latter. It is a Russian financial crisis brought on by the sanctions, trade and financial sanctions imposed on Russia as a result of the conflict over Ukraine, and secondly, by the spectacular collapse in oil prices. It will not have any meaningful spillovers because Western banks and Western financial institutions and financial institutions elsewhere in the world have had many months now as a result of the gradual escalation of the sanctions, including the financial sanctions, to minimize their exposure to Russia. So it's a Russian problem. It will not, I think, lead to any Russian sovereign problems, because the Russian sovereign has very little debt. 20% or so of GDP in debt outstanding. The problems for Russia, the financial problems, as a result of weak oil prices and the spectacular decline in the external value of the ruble, 50–60% or thereabouts, means that corporates, Russian corporates, including Russian banks, that have borrowed abroad in dollars and other hard currencies are going to be in deep trouble, and there may well be insolvencies and defaults there, but not at a sovereign level, no.
So this across-the-board selling we recently saw in emerging markets after the ruble fall is just a passing phase, you think?
Yes, Russia really is a unique case, right? Not many emerging markets have an armed conflict with their neighbor, and not many American markets are as exposed in terms of export revenues and budgetary revenues to the decline in the price of oil. So this really is a Russian problem. There may be some very short-run, temporary contagion to other countries, especially EMs that are commodity exporters, let alone oil exporters, and financially fragile. But Russia really is in a unique position because of the combination of oil dependence and sanctions.
Well, Professor Buiter, let me now pick your thoughts on any other trouble spots for the global economy in 2015 that you can sense now. Can these trouble spots emanate from Europe, especially from countries like Greece or Italy, where we are already seeing some political demands?
I think a financial shock with global impact on financial conditions everywhere is most likely to originate in Europe, specifically in the euro area periphery. As you noticed, Greece is trying to elect a president. If they don't succeed at the third time of asking on the 29th of December, they have a parliamentary election that's likely to result in a hard left dominated government that will have a much tougher bargaining stance as regards debt restructuring than the current government. This could therefore lead, if these negotiations are successful, to unilateral debt restructuring with all the problems this entails. And of course, in the rest of the periphery of the euro area, the statement by Mario Draghi in 2012 that we'll save the euro no matter what it takes, and it will be enough, that statement has caused sovereign spreads to collapse to ludicrously low levels. Countries like Portugal, but especially Italy, have very fragile sovereigns that only, I think, are out of trouble in the last 2 years because of the benign background presence of the ECB. At some point, I think the markets will wake up to the fact that there is material sovereign risk, even among the largest of the euro area periphery member states, Italy, and then we could have a return of sovereign risk in the euro area with a snowball effect in global financial markets.
Well, on that point, Professor Buiter, let me take a break. We will come back with some questions on what you make of the Indian economic scene, among other things. We are back in a minute.